Welcome, everybody, to the Investing in Real Estate show. I'm Clayton Morris, longtime real estate investor and founder of the full-service rental real estate company called Morris Invest. Good to see all of you. Thank you so much for taking time out of your day to build up your financial education. And today is our Q&A episode, so people are able to call in, leave us a question about taxes, real estate investing, the markets, whatever's on their mind, and we will attempt to answer it here on the show. Please come over to our website if you'd like to leave a voicemail question. We've got tons of great blog posts over there, information and resources to help you become a real estate investor. And there's a microphone icon on the front page of morrisinvest.com. Click on that and you can leave us a 30-second voicemail question if you please. But first, I want to tell you about our friends at Lear Capital, because Natalie and I are big investors in precious metals. Yes, we invest in real estate, but a big portion of our portfolio are in precious metals, gold and silver, because of what's happening to the US dollar. It's no secret, if you're tuned in, then you need to know that experts are predicting a big recession headed our way. One economist just said, this is the beginning of the end for the US dollar. So if your savings accounts are tied to the US dollar, look out, folks. Please, please protect yourselves. And we are devaluing the US dollar faster than ever before. And last year was terrible for most investors, but 2023, 2024 could even be worse unless you're smart and you have a portion of your assets in precious metals, other hard assets like gold, silver, and real estate. And that way you can protect your financial future as these other investments start to collapse all around other people. So if you want to invest in gold, our friends at Lear Capital can get you set up and start purchasing precious metals right now, or even converting part of your IRA or your 401k into a gold and silver IRA. It's very, very simple to do. And you can call them. They love talking to people on the phone, so you can see if it's a fit for you. Give them a call today at 1-800-450-1008. There's the number on your screen. We've also set up a special website just for you as well. You can get your free gold and silver investor guide by going to learmorris.com. That's LEARMORRIS.com. And right now, if you call and work with them, they'll get you set up with $15,000 in free bonus metals. That's right, $15,000 in free bonus metals with a qualified purchase. Again, call their 800 number today, 1-800-450-1008. And you can buy gold bars, gold coins sent right to your home, silver coins, silver bars sent right to your home, or held in storage off-site. They will talk you through that entire process. Again, give them a call today, 1-800-450-1008. Okay, let's dive into it today. We've got a couple of great calls here. Let's start with Carl.
Hi, Clayton. My name is Carl. I'm from California. I have about $200K of equity in my primary home, and my second home is breaking even on rent to mortgage. Does it make sense to cash out, refi my primary, then put that $200K towards the second home to increase the cash flow? I eventually will sell it to the renters and do a 1031 exchange when the time comes. Thanks in advance, and I appreciate all the knowledge you share.
Thanks, Carl. Well, I can't tell you what to do with your money. It's a personal preference, but I would say take a look at our book on how to pay off your mortgage in 5 years, because in that book, again, I have to always explain, it's the blue cover. If you go to Amazon and you see how to pay off your mortgage in 5 years, it's the blue cover. Pick up that copy, not the yellow one. And like I mentioned on last week's show, somebody copied our name. So somebody else stole literally the same title of our book. Anyway, it's written by Clayton and Natalie. Okay, that's our book. And in that book, we talk about exactly this problem, right? So how do you want it? Do you want to tackle that particular property, the second home that you're going to sell it as a rent to own? You said you're basically breaking even on it now. I don't know. Does that mean you're bringing in a little bit of cash flow? I want you to remember the Gary Keller model, right? The millionaire real estate investor, which is even if you're cash flowing $1 over all of your expenses and your mortgage payment, then that's a win. Right now you have an asset, okay, that's sitting there and it's cash flowing, and you're not paying the mortgage. Your tenant is right now, okay, so you're doing good. But are you being honest with yourself? Have you also looked at your taxes? What are the taxes on that property? When you include the taxes, are you really coming out on top, or are you underwater? And this is where I would seriously look at the property and decide to yourself, do I want to throw more money at a mortgage, Or am I really upside down in this? Does it make sense for me to even keep it in the first place? Is the ROI there? Here's why I'm asking you this. Because very often people have that second home, which was originally your first home. And I don't know if that was the situation, but chances are that second home was probably your first home. Maybe it was a small town home that you owned and then you moved because you got married and you have kids, but you kept it because you were like connected to it nostalgically or something. And you thought, oh, this will be a good rental. But then maybe the numbers don't make sense. Maybe the property taxes are way too high. The ROI, the return on investment, really isn't there. But you kept it because you thought it felt like a good investment. So maybe it is and maybe it isn't. But I want you to really be honest with yourself on that property. Are you trying to massage the numbers to make it work? Or do the numbers work on their own? Wouldn't it be nice if you were able to get like an 18 to 20, 21 or 22% internal rate of return? Like what if you took that home and as we head into this hot spring housing market, you sell it, make a nice profit, and then roll that money into a 1031 exchange, roll it separately out of there into a more profitable, higher return investment. So personally, I don't want to be throwing additional capital in a big chunk of it towards that mortgage. But I think in our book, we talk about how you can make some nice payments to the principal balance and bring it a little bit more in line. But it's up to you. Personally, you've got all that equity in that primary mortgage, then I would be looking at how can I leverage that primary home money in terms of a home equity line of credit. Remember, you can't eat equity. And how can I take that money and roll it into additional properties and add more assets to my portfolio? So I'm not quite sure. If you and I talked, I might have a better understanding of what that second home looks like and what are the numbers on it. And if you're being truly honest with yourself about if it's profitable or not, or are you underwater in it? And then throwing more money at it, does that really make sense? So I don't know that piece of it, but I do know if you're sitting on equity in your primary, absolutely. I'm a huge fan of tapping into that equity to invest in other properties. So, Carl, if you want to chat with our team at Morris Invest, we can help you out with that. We're happy to talk with you about those programs and at least point you in the right direction. So if you want to book a call with our team, it's totally free. Just go to morrisinvest.com. All right, thanks, Carl. Appreciate it. All right, next question comes to us from Randy.
This is Randy from Amarillo, Texas. I had a question about, we have a paid-off rental property, and our renter is moving out at the end of the year. We were wondering if we should sell it at this time or just keep renting. We also have a property in Angel Fire, New Mexico, and we rent it when we're not there.
Okay, so Randy, why would you want to sell the property? Are you a tired landlord? It sounds like, if I'm hearing it in your voice, you're like, well, our tenant's going to be moving out, so maybe we're just kind of done with that. Now, the way to avoid, this is a cautionary tale, everyone. The way to avoid being a tired landlord is to never be a landlord, is to never manage it yourself, okay? Have a property management team that handles everything for you. So, Randy, I'm not sure if that's the case. If you are managing this property and you have to go in and deal with it on a time, you have to chase them down for rent, you have to do all of those things. It's paid off if you can get great rent for it and it's in high demand. You're in the best landlord-friendly state in the country, in Texas. Why would you sell it? Amarillo's a great town. So it sounds like if you're just sort of tired of dealing with it, I would seriously look up a few property management companies in that town and talk to them about managing the property for you. And maybe they can increase the rents. They can do a whole, so personally, why I wouldn't want to sell a property if it's paid off. What's the point of selling it? Unless you're going to take that money from Amarillo and then use a 1031 exchange and roll it into some additional rental properties, right? Those are some considerations to have there as well. But then, of course, you're going to be paying taxes on that. So if you're going to just sell it outright, you think about the tax bill that you're going to have on that. So I would seriously consider either rolling it into a 1031 exchange into some other properties, or sit on that and just talk with a property management company about getting that thing properly managed for you, so it can cash flow without you having to deal with it. I don't even know when any of my tenants are moving out of my properties. My property management team handles that. And if we check in with them every few months and have a discussion, but I let that up to them. I don't want to know about it other than just making sure we're checking in the health of our portfolio and having that conversation. But I don't really worry about that. And it sounds like you've been worrying about that. So again, cautionary tale, Randy. I don't want you to have to deal with this anymore. Talk to a property management company. All right, our next question.
Hey Clayton, this is Jeremiah up in upstate New York. To my knowledge, the Tax Cuts and Jobs Act that was passed when Trump was president caps the mortgage interest deduction that can be taken each year to $725,000. But that cap is supposed to end in 2025. My question to you is, what does the cap become after that, after 2025? Any information that you could provide would be greatly appreciated. Thank you. Bye.
Thanks so much for that question. So yes, this was a Trump law passed to, it was really, I don't know, it was kind of seen as like a little punch to Democrats back in the day. But yes, it would lower the amount that you could claim as mortgage interest deduction up to you said 725,000. The actual correct number is 750,000. 750,000 is what you're able to claim up to. And then beyond that, you don't get to make that money back in interest on your taxes. So you can only claim up to 750,000. But after 2025, when this law sunsets, it'll go back to the old rules. So it will go back to the $1 million rule. So after 2025, the old rules will apply. It's almost as if this was never put in place. So yes, mortgage interest expenses will be deductible for the home acquisition debt up to $1 million, and home equity will also be up to and available to you up to $100,000. So right now, home equity interest was eliminated from being able to claim on your taxes. That's good news. So home equity interest will be able to come back now. And it will also be pushed up to $1 million. So after 2025, so that's a Trump era law that will sunset. So just to give you an example, I'm just giving you a little example here. So let's say, for example, you have a home acquisition that you got in 2010, okay, for $1 million, and it's a 30-year mortgage. The outstanding balance is $850,000, okay, and that was financed in 2018. You bought it in 2018. If the refinance debt term is 30 years, you got another you refinance the property for 30 years, and then the $1 million limitation applies for the remaining 22 years. So that's under that law. If you did it in that window from 2017 to 2025, that's when you're going to be still adherent to that law. Now, if you're making a new purchase, you do a new refinance, a new mortgage in 2025, the old law now applies to you because that law is now sunsetted and gone. And so now you can redo your loan if you want to and refinance it. So yeah, it's kind of crazy, the sort of back and forth. And then of course you had the state issue too with the $10,000 cap and all of that. So yeah, we're going to see this thing sunsetting here real soon. It'll be interesting to watch and how this affects how it affects certain people. And certainly in like the expensive New Jersey suburbs, which I think this was like sort of clearly targeted at for some Democrats. We're not happy about it. Anyway, funny to watch, but we will see this changing very, very soon. If you have a question, please come over to our website, go to morrisinvest.com, click on the microphone icon on the right side of your screen, and leave us a 30-second voicemail question here, and we will attempt to answer it. Now go out there, take action, become a real estate investor. I believe it's the #1 way to build wealth. We'll see you next time, everyone.